Earlier we have learned about ROE, which was return on equity, when we studied the profitability ratios. In fact, ROE becomes one of the most important ratios looked at by financial analysts, and hence a deeper understanding of how ROE is calculated and what are the key variables which are affecting ROE is very important. In fact, DuPont has suggested two methodologies of calculating ROEs. ROE by very definition is net income divided by the total equity. Now, if we just change this formula a bit by introducing some terms in the numerator and the denominator. So I'll do that. The first is net income divided by sales. So I have introduced sales in the denominator, so I will introduce sales in the numerator so that these two cancel out. Sales divided by assets and assets divided by equity. So if you look at this ratio very carefully, you will find that this is the same. If I cancel these two out, sales and sales, assets and assets, you will have net income divided by equity, which is basically your return on equity. Now when we bifurcate them into three parts like this, it is very useful for us and meaningful in terms of the information that is revealed. We already understand what is net income by sales. Net income by sales is nothing but your profit margins. We'll call this as net profit margin. What about sales upon assets? We have discussed this earlier. This is your asset turnover. And what is asset divided by equity? We'll know that this is a leveraged ratio. So we understand that net profit margin should be ideally higher for a company to perform better. Asset turnovers, we have earlier looked at two cases. One was the retail industry and the other was the manufacturing or a high capital intensive firm. So we saw that in companies like the ones which are in retail, this number could be a bit higher number. Sales per unit asset would be around 8 to 10 times. However, in manufacturing firms, this can be closer to 1 to 2 times. So here we get a better understanding of how ROE comprises of. And the third one is basically the leveraged ratio. So this provides us with a measure of how much assets have been built per unit of equity. So a very important measure to look at. So when we talk about ROEs, we have three different variables on which we can look at in terms of understanding. So this was DuPont analysis. Now there is another thing called extended DuPont. So let us look at what extended DuPont actually means. Extended DuPont. Now extended DuPont essentially aims to calculate ROE, which is again defined in a basic way as net income divided by total equity. So here, like what we did earlier in case of DuPont, we'll introduce some terms in the numerator as well as the denominator. So I'll do that right away. So here ROE will be defined as net income divided by your EBT, earnings before taxes. So since I have included this in the denominator, I'll include the other in the numerator. So EBT divided by EBIT, in interest, earnings before interest and taxes. So since I have introduced EBIT in the denominator, I should include this in the numerator as well. This becomes EBIT divided by revenue, this multiplied by revenue upon assets, and this multiplied by assets divided by equity. So if you closely look at this formula, these things, EBT will cancel out, EBIT and EBIT will cancel out, revenue and revenue gets cancelled out, and assets gets cancelled out. The only thing that remains in that case would be net income and equity. That would mean ROE. But why do we actually split this? The reason could be that it helps us in terms of understanding of the ROE in a better way. What is net income divided by EBT? We'll define this as tax burden. So the amount of tax, or the difference between EBT and net income, is the tax that we have paid. So higher the taxes, if taxes are higher, this ratio net income upon EBT, this will be lower. So the next term EBT divided by EBIT will be called as interest burden. So the way we had called the other one as tax burden, this is called as interest burden. Now in order to effectively understand this EBT divided by EBIT, let's take a case that there is EBIT is, let's say, 500 and interest expenses, let's say 100. So what will be EBT? EBT will be 400. So in this case your EBT divided by EBIT will be equal to 400 divided by 500, that is 0.8. Now what happens if your interest, now the next question comes is what happens if the interest goes up? Say for example, if this is not 100 but this is say 200, so your EBT will become 300 in this case, and the revised EBT will divided by EBIT will be equal to 300 upon 500, that will be equal to 0.6. So now think of a situation where interest rates will go up. When will that happen? This will happen when you may have taken higher debt in the firm. So higher debt would mean this ratio will go down. So that's why interest burden calculation becomes very important. Now the third term that we have is EBIT divided by revenues. So this is nothing but your operating margin, and we understand the implication of operating margins. Higher this margin, the better it is for the company. Revenue divided by assets, this is nothing but your asset turnover. Your asset turnover essentially means that how much of sales are you generating per unit of asset. So we have seen this earlier that in retail kind of companies this is a very high number. However, for companies which are high capital intensive firms like oil and gas or manufacturing firms, this may be a bit lower number. What about assets and equities? Asset upon equity would be called as the leverage ratio. Now what is the leverage ratio all about? Leverage ratio is basically how much you have developed in terms of your asset per unit equity. So this also gives you a flavor of how much debt you have employed in the company. So higher the leverage ratio, that means you may have taken higher debt in the firm. So in fact if you look at these two terms, EBT divided by EBIT versus asset divided by equity. So I have taken only two terms from this one and the other one. Now when we talk about this, let us see what happens when there is higher debt which we have taken. Higher debt would mean EBT divided by EBIT. This will go down. We have seen this earlier. However, when we talk about assets and equity, obviously if debt goes high, that means your total assets will move up. So this number will move up. So what we see is that these are having opposite effect, and EBT divided by EBIT will lower your ROE. However, your asset upon equity will improve your ROE. So you cannot say that higher debt will lead to higher ROE. So you need to watch out for what is your interest expense accordingly. So let us now move and look at an example where we calculate ROE using two measures. One, the original one, net income divided by total equity. We look at the second formula, which is DuPont formula, and the third one as extended DuPont formula.